Welcome to Acera's new employee / mid-career seminar. In this seminar, we're assuming that you are either new or you're somewhere in your mid-career. So hence the name of the seminar. Since you're not near retirement yet, that's a good thing because it means you still have plenty of time to plan for retirement. So in this seminar, I'm going to tell you all the things that you might want to know about doing that planning for retirement. And since you're curious enough about retirement planning to watch this, you probably have some questions. Questions like, what do I need to know about my pension? Do I need to do anything? And if so, what do I need to do? So we're going to get all those questions answered for you today. I have organized the presentation in the form of this checklist to kind of ease going through the different topics. So the first thing we're going to talk about is I'm going to help you understand retirement basics. So we'll talk a little bit about pension math. And in the next check item in the checklist, I'll tell you about the retirement formula. We'll talk a little bit about purchasing service credit. I will also help you get a pension estimate or understand how to get a pension estimate for yourself. I'll help you understand retirement eligibility. So that's when you actually become eligible to retire. I will help you understand some additional benefits that we offer, like healthcare benefits. We'll talk about designating your beneficiary or beneficiaries for death benefits. I'll help you understand different career planning options in case you decide to leave your current employment. We'll talk about making a retirement planning picture regarding your future retirement income. And then we'll talk about starting a 457B account, and that's about when the presenter from the county's 457B program will come in, and we'll talk briefly about signing up for Acera News. Okay, so let's jump right in. Well, first item on the checklist is understanding retirement basics. And let's see, there's a question, is this webinar only for employees that have a pension? I do not. So the first part of it is going to be all about the pension, all the way up until we get to making a retirement planning picture. And then there may be some information for you in there. So that will be maybe like an hour and a half. We'll get to that part in the checklist. So if you want to return for that, you can, and I'll listen to that part and the 457B presentation. But yeah, the first part of it is geared toward people who are Acera members participating in the pension plan. Okay, understanding retirement basics. So who is Acera? First of all, Acera is this acronym, the Alameda County Employees Retirement Association. But Acera is made up of a lot of people. Okay, so there are about 90 of us that work at Acera, and what we do, our entire job, is to provide retirement, disability, and death benefits to our members. And that's all of you. You are members of Acera, so you are also part of Acera. And you're a member of Acera because of the position that you work in and who you work for. So you work currently, or at some point you worked full-time, and you work in a retirement eligible position for one of these 6 participating public employers in Acera. So because of that position that you hold, and because of who you work for, that automatically makes you an Acera member. And as an Acera member, you contribute to Acera's fund with every paycheck. So every time you get paid, you will see on your pay stub, there will be a line in the before tax deductions column that says retirement something or other. It'll probably have your tier in there, which we'll talk about in just a minute. And you'll see an amount come out of your check before tax, and that goes into Acera's fund. And whenever you contribute, your employer also makes contributions on your behalf. So what do we do with that money? Well, we don't want it to just sit there. We invest it all over the world, and we earn a lot of interest on that money. Okay, so these 3 sources of income, you contributing to the fund, your employer contributing to the fund, and the investment earnings gives us this big pool of money that we call Acera's fund. So then what do we do with Acera's fund? Why are we collecting all this money? We are collecting all this money and earning all this money because meanwhile, you are earning credit toward retirement with Acera. So while you work, you earn credit toward retirement. And that can mean a few different things. You're kind of earning credit in 3 different categories, and I'll tell you about that in just a minute. So you're earning credit while you're working toward retirement, and then at some point in the future, you're going to retire. And once you retire, you're going to collect a monthly retirement allowance for the rest of your life. So that's what we're going to do with all the money. We're going to pay you out a retirement allowance every month for the rest of your life. You cannot outlive your retirement. It's going to happen every month on the last business day of the month, as long as you live. So that is the beautiful thing about participating in a defined benefit pension plan like ACERA. Pensions are very special because you're contributing to the fund throughout your career, right? And then when you go to retire, all that money that you paid in throughout the course of your entire career, through those monthly retirement allowance payments, you're going to get all that money back within the first 3 to 5 years of retirement. And then if you're retired many years after that first 3 to 5 years, hopefully you live a long life. Maybe you're retired another 20, 30 years after that first period. That is, kind of like pure bonus for you. And it is the employer contributions partially that allow us to do that pay lifetime retirement allowance. But mostly it's the investment earnings that pays about 75% of your lifetime retirement allowance. And that's why we're able to give you all your contributions back within the first 3 to 5 years of retirement. So there's no other investment strategy that works this way. It's really an amazing thing to be able to participate in a pension. And what it does is it gives you that amount of money, that retirement allowance that you can count on every month for the rest of your life, plus cost of living increases. Okay, so let's talk some more pension basics. There's this milestone chart that I want to show you. These are the different milestones that you will see with your membership in ACERA. Okay, so your first milestone is your date of hire. That is either if you started out working in your full-time retirement eligible position, that is the first day that they told you to show up to work. Okay, that's your date of hire. Now, if you started out in some other capacity, like maybe you started out part-time or working for the county's temporary assignment pool or something like that, this date of hire is the first day of your full-time retirement eligible position. Okay. And then what happens is 2 weeks goes by, and the first day of your second pay period, that is your first day of ACERA membership. That's also known as your ACERA date of entry. And that is when you start earning credit toward retirement. Now, there's an exception. I think Livermore Area Recreation and Parks District and the Housing Authority, your date of entry and date of hire are the same. So you enter ACERA immediately upon your date of hire. Okay, so once you're in ACERA, what happens is 5 years goes by. So you work full-time for 5 years, or the equivalent of full-time 5 years, and then you're considered vested in the retirement system. And vesting just means you're guaranteed the vested benefits. Vesting just kind of means guaranteed. So you're guaranteed the guaranteed benefits basically once you're vested in the system with 5 years of service credit. The next milestone is that at some point after you become vested, you become eligible to retire. And it's based on a combination of how old you are and how many years of service credit that you have worked. And everyone has kind of a different combination that gets them to the retirement eligibility. I'll talk more about that later on in the presentation, about how you uniquely become eligible to retire. Okay, then sometime after you become eligible to retire, it could be on the same day. You might be ready to retire immediately as soon as you're eligible, or you could keep working and earning more credit toward retirement. There's going to be a date that you choose, and that is your retirement date. Okay, so sometime in the future after that, you choose your retirement date. You tell us you're going to retire by submitting a retirement application, and then that's your first day of retirement, your retirement date, and that is when you start collecting the retirement that you earned throughout your career. And you're going to collect that retirement, like I said, every month for the rest of your life until your death. And that's when your retirement payments stop. But depending on which one of the retirement options you select at the time of retirement, you can leave a continuing payment to a beneficiary, and sometimes more than one beneficiary. That's also known as a continuance. And so that can continue until the beneficiary's death as well. Okay, so that's why there's an additional milestone on here. Okay, so let's see. I have a question about PERS. That's regarding this topic of reciprocity. I'll save that for later. Let's see. And then there's a question about buying back credits for the first 2 weeks of employment. Okay, so since we're on that topic, the question is if you, and we'll talk about purchasing service credit in just a minute, but the question is if you buy back the service credit for the 2 weeks in between your date of hire and your date of entry into Acera, is that first 2 weeks, does that push back your date of entry to Acera? No, it doesn't. Your date of entry is your date of entry and it doesn't change. If you have eligible time to purchase that is before your date of entry, all that does is increase your amount of service credit in the retirement formula that we're going to use for you. So thanks for that question. Okay, now just a little bit more about vesting before we move on. Like I said, vesting is with 5 years of service credit, and that includes actually reciprocal service credit. So we do have a question up on the board about reciprocity. We have a couple of questions now, and I will go. I will talk in detail about reciprocity later on in the presentation. But for right now, I'll just mention that reciprocity is where you have worked for another public employer in California previously, and when you left that job and you entered this job, you were able to link the systems together. So whatever the pension system they had, you were able to link it up with Acera, and you kind of form a synergy between the two retirement systems that kind of keeps you from starting over from scratch in terms of earning your retirement. And so reciprocal service is included in vesting. So if you worked for, let's say, Marin County, which we have reciprocity with every county in California, for 4 years, you come over to Acera, you work 1 year, you have 5 total years among every reciprocal system that's linked together, and that gets you over the vesting requirement. So then you are considered vested. Okay. Oh, good. I picked you did work with Marin, so that was a good example. And let me check on this question real fast. Okay, so now there's a question. If you worked for another county previously, does this job add to this Acera service credit? It does not. Your service credit with the other job stays over there, and then you start earning Acera service credit. And then I'll get into that when I talk more about reciprocity. Okay, and how to link the systems, because I see that you have a question on how to link them up. Okay, and I do have a question about explaining the term vested again. Vested just means guaranteed. So when you're vested, you're guaranteed the guaranteed benefits. The guaranteed benefits are guaranteed by state law. So it's state law that allowed us to form the pension system and tells us how to run the pension system. And the state law is what guarantees the guaranteed benefits. So here they are, the vested benefits, also known as guaranteed benefits. The monthly retirement allowance for life, an annual cost of living adjustment, which is an increase to that allowance, and then a $1,000 lump sum death benefit in retirement. And there are other death benefits available, which I will go into regarding active death benefits during the presentation. Okay. And then it's 5 years total until you're considered vested. Okay, five full-time years. And I'm going to save some of those other questions for later. Okay, let me talk about tiers real fast. So you're in one of these tiers. If you're a safety member, you may have 2 tiers, okay? And the tier that you're in is based on when you entered Acera. So it's based on that Acera date of entry. Now, what you're going to do first is find the timeline that you're looking at. So safety members are sheriff's deputies and probation officers and perhaps other sworn officers out there that I'm not aware of. And if you're a safety member, you usually know it. And then everyone else is a general member. So you're considered a general member. So you're either a safety member or a general member. Now, if you're a safety member, you're going to look at this timeline for the tiers to figure out your tier. If you're a general member, you're going to look at this one, unless you're a general member who works for the Housing Authority or a general member that works for Livermore Area Recreation and Parks District. And then you're going to look at the specific timeline for your employer. Okay. So look at your timeline. And the way this works is it's based on your date of entry into Acera. So if you entered Acera, for example, you're a general member, let's say you work for Alameda County, and you entered Acera before July 1st, 1983, that would put you in tier 1. Now, if you entered Acera July 1st, 1983 and beyond, all the way up to December 31st, 2012, that puts you in tier 2. So you can see if you entered before the cutoff date, that puts you in the earlier tier. If you entered on the cutoff date, all the way up to whatever the next cutoff date is, that puts you in that tier 2 or tier 3 in the case of LARPD. And then if you entered Acera January 1st, 2013 and beyond, you're in tier 4, okay? So that's how that works. Now, Housing Authority and LARPD have kind of different dates. LARPD has a different tier. Okay. So just be cognizant of that if you work for one of those employers. Now, the tier 2, so I have a question about tier 2A and tier 2B. Tier 2A is really the general member tier 2. Okay. Tiers 2B, 2C, and 2D are the safety tier 2. There's 3 tier 2 safety tiers. Okay. And so for safety members, if you entered ACERA, you can see what the cutoff dates for you. For this period here, if you entered ACERA October 17th, 2010, all the way up to December 31st, 2012, you were either in tier 2C or tier 2D. And the tier that you're in depends on, you made a selection within the first 45 days of becoming a safety member. And depending on which tier you selected is which tier you went into. Now, if you don't remember which tier you picked, and this goes for everyone, actually, if you just want to see what tier you're in, for sure, you just log into your account on our website and it will tell you what tier you're in. Okay. So now that you know what tier you're in, that will help you understand more of the details that I'm going to tell you regarding how we calculate your retirement and what you can expect from your as your retirement benefit when you go to retire. Okay, now this next slide, I'm just going to show you this briefly because we're going to revisit this, but I just want to provide some context for the entire discussion that we're having. Because really what I'm trying to help you do in this webinar is help you plan for the future. So we're going to just take a little peek into your future and see what your retirement income might be years from now when you are ready to retire. And that can feel stressful. I understand that. Like, you know, it's years from now. Am I going to make all the right moves? Am I going to do all the right things? Am I going to have enough money to retire? You know, what's going to happen? I get that all this stuff can be stressful. So I'm going to break it down for you really simply as the last topic that we talk about. But I just wanted to show you this slide just to show you that we're going to talk about this and give you some context. So when you go to retire, you're going to need income because you're not going to be working anymore. Your employer's not going to pay you anymore. And what financial planners will tell you is that in order to maintain your standard of living in retirement, you are going to need 70 to 80% of your working salary that you were making before retirement. You're going to need that in retirement in order to, like I said, maintain your standard of living. And that's going to come from a few different places. So there's your ACERA monthly pension. There's also Social Security, if you're paying into the Social Security system, which all general members are, safety members are not. And anything beyond that is your own personal savings and investments. Okay, so we'll talk a lot about the ACERA monthly pension in the first part of the presentation. And then when I talk more about retirement planning, we'll hit on these two topics. So I just wanted to show you that we're going to get there. Okay, and we're going to talk a lot about the ACERA monthly pension first. So let me help you regarding the ACERA monthly pension. Let me help you understand how we calculate what your benefit is going to be. And this helps you understand like how you earn credit toward retirement, how fast you're earning credit toward retirement, and what categories you're earning credit. And this will really help you plan for retirement throughout your career if you kind of grasp these concepts. Okay. So let's talk about pension math. And the pension math is super basic, so don't get stressed out about it. When you go to retire, so looking into the future to your the time that you're going to retire, your retirement date, what we're going to do at ACERA is we're going to do a calculation for you to determine your retirement allowance that you're going to get every month for the rest of your life. And what you're going to get in that allowance, you're going to get a percentage of your highest working salary for each year of service that you work. Okay. So that is a kind of English sentence way to describe what's happening in this multiplication formula. We're going to multiply these three things together, and that's going to tell you your retirement allowance every month for the rest of your life. Okay. Let me give you an example of how this works. And when I said you're earning credit toward retirement, you're kind of earning credit in these three categories. Okay. So let's say that the percentage of your highest salary, your highest working salary that you're going to get for each year of service, let's say it's going to be 2% of your highest salary. Okay. And let's also say, for the purpose of this example, that you work for 20 years. You work 20 full-time years or the equivalent. And so you have 20 years of service credit in the formula for you. So your retirement allowance is going to be 2% of your highest salary for each one of those 20 years. So for each one of those 20 years, you're going to get 2% of your salary. Okay. That means that you're going to get 40% of your salary, because we'll multiply the 20 years times 2%, that's 40%. So your pension, your retirement allowance, and these are synonymous terms, your pension, your retirement allowance, your retirement benefit, they all mean the same thing. It's going to be 40% of your working salary. Okay, so to continue the example, let's say that your working salary is $5,000 per month. You're going to get 40% of that as your retirement allowance. So your retirement allowance is going to be $2,000 per month. That's how that works. Pretty basic, right? Okay. The bottom line here is that the higher, because this is a multiplication, the higher any of these numbers are in the multiplication, the higher your retirement allowance is going to be. So the higher that percentage, the higher that age factor percentage, the more service credit that you earn, so the more years you work, and the higher your salary, that equals, when we multiply it out, a higher monthly retirement allowance for life. Okay, so when you get raises, you're earning more salary, that will show up in an increased monthly retirement allowance. You work more years, that will show up in a higher monthly retirement allowance. You just get older, your age factor percentage is based on your age at retirement, that increases your retirement allowance. Okay. So let me talk about each one of those in a little more detail, and it will help you kind of understand and remember more about how you're earning credit toward retirement. So first of all, I'll talk about the age factor percentage. How do we determine what the age factor percentage is for you? What percentage of your highest salary will you get for each year of service? Well, it's going to be based on your age at retirement and what tier you're in. So this is a sample age factor percentage chart. Now, what you're going to want to do is find the column for your tier. So if you're a general member and you're in tier 4, you're going to just look at this column and forget about all the other numbers. Okay. So just find which column that you're in based on, we talked about which tier you're in earlier. And then you just look at that set of numbers. Okay. Now, the way this works is when you go to retire, we're going to take one of these percentages out of this chart and use it in the formula for you. And it's going to be based on your age at retirement. So if you're a tier 4 member and you retire at age 62 and you're a general member, what we're going to do is we're going to come over to tier 4. We're going to go down to age 62, look at where those intersect, 2%. So that would actually give you that 2%. Now, if you decide to wait another 3 years, you're either working another 3 years or maybe you're not even working another 3 years. You're just getting older and retire at age 65, you would actually get a higher percentage of your highest average salary for each year of service. You would get 2.30% in the formula for you. Okay. You'll notice that each one of the tiers maxes out at a certain percentage. And that is what the blue box represents for each one of the columns. Okay. So you can see that, like for general tier 2 members, for example, it maxes out at 2.43% at age 65. If you retired at 65, you get that 2.43% in the formula for you. If you retire at 66 or 67 or 68, it's still 2.43%. Okay. So in that case, if you reach the maximum age factor for your tier, you'll be receiving the maximum percentage. Okay. Another thing that you might notice about the chart is there's a bunch of gaps here. I skipped a bunch of the ages, and that's because they don't all fit on the slide, because they actually increase with each quarter year that you don't retire. Another way to say that is with each quarter year that you get older, you go up one notch in this chart. So there's a little incremental increase for every quarter year. And if this were the full chart, it would say 52, 52 and a quarter, 52 and a half, 52 and 3/4, 53, and so on and so forth. And there'd be a slightly higher percentage that you would get for each one of those quarter years that you age. And because it's based on your age, it's going to be based on your birthday. So the quarter year dates, like for example, January 15th is your birthday. So one quarter after that is April 15th. Another quarter after that is July 15th. Another quarter after that is October 15th. And then back to your birthday. So every time you pass one of those dates, you go up one notch in this chart and you would get a slightly higher age factor percentage. Okay. That's how the age factor percentages work. If you want to see the whole chart because you enjoy math, you can find that out on our website. You can go to acera.org/age, or you can just search in the search blank. Now, that's a lot of detail. If you don't want to remember all the detail, the bottom line here is that an older retirement age equals a higher age factor percentage, up to the maximum that you can get for your tier. Okay. So that's one way that you're earning credit toward retirement, is by getting older. Okay. We talked about the age factor percentage. Let's talk about service credit. So you earn service credit by working. And when do you earn service credit? When don't you? How fast do you earn it? Let's talk about all that. Okay, you start earning service credit when you enter Acera. That is on your Acera date of entry, whatever day that is. Okay, like I said, you can find that out in your account if you log into your account on our website. Now you're going to start earning service credit on that day, and you're going to earn service credit all the way up. If you go straight into retirement, you're going to earn service credit all the way up until your last day of work. Okay, so you earn credit while you work. You earn credit during your entire career with the retirement system. Okay. So that's the period that you're earning service credit is while you're working. So yes, the times when you earn service credit is during regular work hours, also during your earned leave times. So earned vacation leave, sick leave, management leave, comp time, holidays, floating holidays, all of those earned leaves, you're earning service credit during those times. Those do not count against you in terms of calculating your service credit for retirement. Okay. Now, there are some times when you do not earn service credit. Okay. And that is when you go on leave without pay. If you do, you don't earn service credit while you're on leave without pay. Okay. Because you're not working, you're not getting paid. You're not earning service credit. Okay. Now, purchase vacation. Some of our employers, many of them, including Alameda County, will allow you to purchase additional vacation on top of your earned vacation. So when you purchase that extra vacation and you go out on that purchased vacation by marking on your timesheet, the code for the purchased vacation, while you're out on that purchased vacation, you don't earn service credit during that time. And that's not purchasable time later. Okay. So that's the bad news. The good news is that a little purchase vacation here and there is not going to be a big deal in terms of missing out on, a week here and there for the amount of service credit in the formula for you. So don't even worry about that. Plus, the other good news is you got to go out on a nice vacation. Now, you don't earn service credit for sold vacation. So that's when you sell your earned vacation back to your employer rather than taking the vacation. You don't earn service credit for that sale. But if that sale happens in the period that we use to calculate your salary for retirement, you could earn some salary credit depending on your tier. That's a complicated topic that we're not going to go into in this presentation. But so you can just remember, for the sold vacation, you don't earn service credit. Okay, now overtime, on-call time, standby time, you don't earn service credit during those times, just your regular work hours. Okay, so let's talk about purchasing service credit, because you probably all have a few questions. I've referred to it a few times. I actually see a question up on the board about whether it's worth buying back some time from a little while ago. And I will answer that question. And actually you can answer that for yourself, and I'll show you how to do it. So let's talk about purchasing service credit. So the concept here is that while you're working, you have all the service credit that you've earned. Okay. Now there's other types of time that if the situation was slightly different, maybe you could have earned service credit during that time. But because the situation was what it was, you weren't allowed to earn service credit during that time. But they give you the ability to go back and buy that time as service credit to increase the amount of service credit that we will put in the retirement formula for you. So here are the categories of service credit purchases that you can make, the categories of time that are eligible to for you to purchase as service credit. Okay. So this first one, ineligible non-covered service time that you can purchase, perhaps. So that is let's say that you started working out part-time for one example, so part-time work in your current position or for your employer, and you did not work a full-time retirement eligible position yet. Okay. So, and what I'm talking about here when I'm saying part-time work, I'm not talking about working for a temporary agency, also known as a temp agency, or under contract, or for any employment agency. This is just plain old part-time that I'm talking about. Okay, so you did not earn service credit for it when you worked it because you need to at least work sometime in that full-time retirement eligible position to start earning service toward retirement to enter a SARA. So you can actually go back and buy that part-time work and add to your service credit. So TAP time stands for the county's temporary assignment pool. If you worked as a temporary worker for only the county's temporary assignment pool, all that time is purchasable. If you worked as a seasonal employee or an intermittent employee or service as needed or for a project or per diem, these are all kind of related. They're kind of similar types of work. And again, this isn't under contract and this isn't for a temporary agency. Those times are eligible for you to purchase. And then ineligible employment is kind of a catch-all. So there may be another category in there that's eligible for one of those 6 SARA participating employers. Okay, so that's kind of the description of how that time works. Now, I did get a question about the days between your hire date and your entry date. Those are purchasable. So yes, you can purchase that 2 weeks. So unpaid medical leave, if you ever during your career go out on unpaid medical leave, upon returning from that medical leave, you can buy that time. And so the medical leave is for your medical condition, not for family member's medical condition. And you can buy 1 year worth of unpaid medical leave per instance. So if you're out on a year of unpaid medical leave, you return and work a little bit, go out on another year of unpaid medical leave, return and work, you can buy both of those 1 year periods. State disability insurance leave is kind of similar. That is purchasable time. So you're out on state disability leave. Sometimes you will get paid a partial check from your employer and a partial check from the state disability system. If you're getting paid a partial check from your employer, you actually will be earning kind of partial service credit for that time. So then the other part where you're part of that time where you're getting paid from the state disability insurance system, that would be the purchasable portion of that time. And again, that's upon returning from that leave. Same thing with military leave during membership. You can purchase it upon returning from that leave. And these 3 are during your active membership. Okay, so you're not quitting your job. You're still actively employed. And you're just going out on these types of leave. Now, these 2 here, redeposit of prior memberships and redeposit of community property. So let me do redeposit of prior memberships first. That is where you used to work for one of our 6 participating employers. You earned service credit. You paid it in the system during that previous work. And you stopped working. And when you stopped working, you took a refund of all of your retirement contributions that you had paid in. And you went and did something with them and worked somewhere else. Then you return, you get another job for one of our 6 participating employers, and you realize that you earned a bunch of service credit that you don't have anymore, and you want to put all that money back to get your service credit back. Well, you can do that. It's called a redeposit of a prior membership. And so you have to pay the full redeposit amount. For the other types of time, except for redeposits, you could actually just buy a portion of the time if that's all you can afford. For the redeposit, it's all or none. Okay. And but yeah, you can put that money back and get your service credit back. Now, the redeposit of community property, the way that works is so if you were married or you were in a state registered domestic partnership and you get divorced or dissolve that state registered domestic partnership, because your SARA retirement benefits are considered community property up for division, there's many times it's very common for an ex-spouse to take part of your retirement account. And what they do is they get like part of your contributions and part of your service credit goes with it. Okay. Now, and they get a separate account that just holds their service credit and contribution. Now, if they take a refund, if they decide that they want that cash, then we will send you a letter and tell you that they did that, and you have the opportunity to pay that money back in, sort of. You pay that amount back in, and you get your service credit back. Okay, so that's a redeposit of community property. Now, there's this last type of time that's eligible for you to purchase, and that is if you other California prior public service time. So that is you used to work for another public employer in California, and you're not eligible for their pension. Okay, and you're not eligible for their pension because you probably didn't work there for very long, maybe, or you took a refund of your amount from their pension. If you did that, you can buy that time as a SARA service credit. So for example, if you worked for East Bay Mud for 4 years, a long time ago, and you took a refund from their pension system when you left, and you want to buy that 4 years as a SARA service credit, you can do that. You would be buying 4 years worth of credit, and we would do a calculation for you to tell you how much to pay, but you would get 4 more years of service credit for that. This one can be expensive, and I'll explain why in just a minute. But it's pretty much, many other agencies in California you can do that with. And I just want to draw a distinction here between Reciprocity, which is linking retirement systems together, and this. If you already have established Reciprocity or you're planning on doing it, you're not purchasing service credit from a different employer. So you can kind of put that out of your mind. You already have service credit with a different employer, and you're actually going to get payment from their pension system. Okay, what we're talking about here is you're not going to get a payment from their pension system because you've taken a refund of your contributions account in their pension system. Okay, let me check the questions here. Okay, so yeah, you had asked a question, would the redeposit be your case with the Marin County example? It sounds like you have reciprocity. So yeah, like I was saying, if you have reciprocity with a different county or a different system, we're not talking about purchasing that time. You're gonna have reciprocity, which we'll talk about in a little bit. Okay. And let's see, there's a question, will you show a calculation example for a service credit purchase? I don't have a calculation example because they're all kind of different, but I will show you what we do, like what the cost is going to be. I'll tell you how we're going to determine the cost for the service credit purchase. And I think like on the next slide. Okay, there's a question, is it within a certain time frame to purchase back time for FMLA and maternity leave, which would fall under the category of unpaid medical leave? And there's the only limitation that you have for purchasing service credit is you have to finish paying for the service credit purchase before you retire. Otherwise, there's no cutoff date for purchasing service credit. Now, you will want to purchase it as soon as you can, which I'll explain in just a minute, because the longer you wait, the more expensive it gets. So let me just check the rest of these questions. Okay, this is a question about what it's going to cost and how long after you complete the purchase does your service credit increase. I'm not sure how long it takes for the service credit to register in our database after you finish paying for it. I assume it's probably within a month, so it's probably 2 to 4 weeks. But if it's been a long time and it hasn't been showing up, then you probably want to call into our member services line, or you can write in, you can send us an email. And the way to contact us, I'll switch over to our website. I can show you. Is we have a contact page. So here's our homepage. And if you go under About Us Sarah and you go down to Contact Us, there is a way that you can email us here, a contact form, or you can call us. And our phone number is 510-628-3000. So that would be a good question for our member services team. And they're available 9 to 3 on weekdays, non-holiday days. Okay, there's a question. If I worked for another county for 4 years during the tier 2 time period, left the county and withdrew my contributions and have now entered a SARA as tier 4, is it possible to have my tier changed back to tier 2? I don't know the answer to that off the top of my head. There may be some information for you on that. If you go under understanding your SARA benefits and you go down to find your tier, there's some information down here about previous work putting you into an earlier tier. So I would recommend reading that, and during the break time, I'll check that out and see if the question is answered in there. So sorry, I don't know that off the top of my head. Oh, and somebody else is making a comment. They said it took 3 to 5 business days for the purchase service credit to appear in their account. They just purchased 5 years worth. So thank you for that comment. Okay, let me switch back to the presentation. Let me tell you how much it's going to cost. First of all, I'm going to tell you what time is not eligible for you to purchase. Okay, like I said, vacation purchase time. If you purchase additional vacation on top of your earned vacation, that's not eligible for you to purchase time. Non-medical leave without pay, that's not purchasable. Only medical leave without pay. Like I said, contract or temporary agency time, not purchasable. Or other prior public service time where you still have contributions on deposit with the other agency. So if, for example, if you worked for like the city of Oakland for a year and you still have contributions on deposit with their pension system, you're going to have to take a refund before you can buy that other prior public service time. Okay. And I do see that there are a number of other questions up on the board, and I will get to all of those. So yeah, don't worry. Oh yeah, and you're welcome. Absolutely. Now there's a question real fast. Is maternity leave considered medical leave without pay? It depends. What will probably happen, let me go back to the list. We're talking about unpaid medical leave here. What will probably happen when you go on maternity leave is you will first go through your leave balances. So you'll go through your sick leave time and your vacation leave time, depending on how your employer wants to handle that. And so during those times, you're already earning service credit, so you don't need to purchase it because you've already earned it. Now, if you're still on maternity leave and then you're on unpaid medical leave because you've run out of your earned leave, then that is the unpaid leave time between that time when you run out and when you return from the unpaid medical leave that we would be looking at for you to purchase. Okay, so what is purchasing going to cost you? What it's going to cost you is your employee contributions had you worked the time. So for example, let's stick with that unpaid medical leave example. So let's say that you go on 3 months of unpaid medical leave, and then you return from that leave and you start working again. During that time where you were on unpaid medical leave, you were not getting a paycheck. And because you weren't getting a paycheck, you weren't contributing retirement contributions, employee retirement contributions to the retirement system. Okay. So had you worked that time, you would have been. So what your cost is going to be is whatever you would have contributed had you worked for that 3 months in this example. Okay. And everyone kind of pays a different amount into the system. Your percentage of your employee retirement contributions for tiers 1, 2, and 3 is based on how old you were when you entered a SARA. For tier 4, everyone pays the same rate. If you want to know more about what percentage you're paying into the system, you can go to our website. You can go to Understanding Your Benefits. And then there's a page on contributions and rates, and it will help you find there. It talks about average rates, and then it will help you find your individual contribution rate. Okay. If you're curious, but really probably the better way to think about it is you look at your pay stub when you get back and you just think about the dollar amount that you would have paid during those months that you were out. Okay. And that would be your dollar amount contribution wise that you would have had to pay. Okay, now you're probably seeing the bottom half of the slide now, and you're like, what the heck is that? Interest. Well, had you worked that time and had you paid into the systems for that 3 months, sticking with that example, that money would have gone into a Sarah's fund and we would have invested it. Okay. And so you're going to have to pay that money that the interest amount that your contribution would have earned had it been in the system for us to invest. Okay. And that is why the longer you wait to purchase service credit, the more expensive it gets, because the longer you wait, the more opportunity that money would have had to earn interest. And you're going to have to pay all that interest. Okay. And we post interest to all of your contribution accounts at the end of June and the end of December, so twice a year. So every time we pass one of those interest posting dates, the cost for you to purchase that service credit goes up and up and up. So the time for you to purchase service credit is as soon as you have the ability to do it, because that will be the cheapest purchase for you. And how do you actually do this if you wanted to do it? Well, you fill out our purchase redeposit request form. So you can log into your account on our website and fill that out. Currently, there's a web form up in there, but pretty soon we're switching all of our forms to DocuSign. And so within the next few months, we're going to be launching all of our forms through DocuSign. In fact, we're launching our new retirement application in DocuSign today. So you can do all of your form signing digitally. And you submit that form, and what we'll do is calculations to tell you whether the time is purchasable and how much it's going to cost. And then we'll send you a letter detailing that account, and you'll see in the letter how much it's going to cost. And then at that point, you can decide if you want to make the purchase and how much of the service credit you want to make the purchase, if you want to purchase all of it or just a portion of it. And like I said earlier, for the redeposits, it's all or none. You have to purchase the whole thing, but for the other types of time, you could purchase a portion of it. And then you have these payment options. You could write us a lump sum check on a post-tax basis. You could roll over pre-tax money from a different retirement account listed out here. You could do payroll deductions. So we'll split it up for you over time and take it right out of your paycheck, but that is post-tax. And then, or you could do any combination of those. Okay. And you would work with our service credit purchase team whenever you're ready. And there will be details in the letter about how to make that happen. Okay. Now, I did have some questions earlier. And actually, there's a tax question here. Let me get to that real fast. Can I roll over pre-tax HSA from another company? I'm not sure if this is the complete list of types of a health savings account. I've never heard of rolling over health savings account money for a service credit purchase. That would be a question for our member services team. So I would write into them about that. But I think this may be the complete list of types of accounts you can roll over money from. And then there's a comment. Unfortunately, the information regarding the timing of taking advantage of the opportunity to purchase service credit isn't provided or made available to new employees. I apologize for that. That's on me. If you did not hear that information, if we did not tell you, like if that news did not get to you, I apologize. I am really sorry for that. So hopefully you're able to do it now without too much expense. But yeah, we will definitely get that fixed in the future. So yeah, I apologize for that. I mean, it kind of is my fault because I'm in charge of the communications for Sarah. So I need to do better about getting that information out there. We are working on a new employee video. So new employees will get a kind of a very basic 5 to 10 minute primer on these topics. Okay, so is purchasing service credit worth it? I did have a question up there about whether it's worth it. Okay, so, and the question was specifically, you had some time, maybe 1 1/3 years, but that was 20 years ago. So is it worth it? Okay, here's how you figure out whether it's worth it to make a service credit purchase for you. First of all, you're going to want to do fill out the request. So do the service credit purchase request. Let us do the calculations for you. Let us tell you how much it's going to cost. Okay, on the letter. Okay, then you're going to go to your account on our website. You can go to our homepage and click the login button. And in order to log into your account, you can go to acera.org/WMS, which stands for Web Member Services. And you can log into your account. If you've never done it, you can go ahead and create an account in there. You'll have to answer some security questions and then create a login username and password. But yeah, go ahead and do that because there's tons of information about your pension in there. Okay, when you get in there, there's going to be a tool in there called the Benefit Estimator. I think it says Estimate a Benefit. And you're going to run 2 estimates in there. So you're going to think of this retirement scenario for you. I'm going to retire, let's say 10 years from now or 20 years from now or whatever it is. So you pick a retirement date that kind of meets that retirement scenario. And you do the estimate based on that date. Now, in the estimator, there's a service credit override field where you can change your amount of service credit that it is calculating for you. You do not override your service credit in the first estimate. You just run it normal. And then it's going to give you your retirement estimate PDF with a dollar amount telling you what an estimate of your monthly retirement allowance is going to be when you retire in this scenario. Okay, so that's estimate number 1. Then you're going to run a second estimate. It's going to be the exact same retirement date because you're doing the same scenario. But the one thing that you're going to change is you are going to override the service credit amount in the second estimate. So what you do is you take the service credit calculation that is projecting for you in this scenario, and you add to it the amount of service credit purchase that you wanted to make. So in your example, you wanted to purchase 1 year. It was 1.34 years. Okay. So you would take, let's say that in the scenario, it told you it was going to project 20 years of service credit for this retirement date. So you would take the 20 plus 1.34, and then you would take the new grand total 21.34 and put that in the service credit override field. Okay. So you have increased your service credit purchase for estimate number 2, and then you press submit and run the estimate. In estimate number 2, your retirement benefit estimate is going to be higher because you have more service credit in estimate number 2 because you made the service credit purchase. Oh, I actually have a screenshot. I don't have to just have you imagine it. Here is the benefit estimator. Here's where you're putting in the projected retirement date, okay, and you hit calculate, and then it's giving you a projected service credit. So here's the service credit override field. This is where you would add the amount that you want to purchase to this number and put the new total in the service credit override field for estimate number 2. And then you hit get estimate. Okay. Now, what you're going to do is you're going to look at the retirement benefit estimate on both estimate number 1 and estimate number 2, and you're going to look at the difference between them. So subtract the smaller one from the bigger one. Subtract estimate number 1 from estimate number 2 to get the monthly allowance difference. So this tells you what the effect of making that service credit purchase is going to be on your monthly retirement allowance. Okay. Now to go even further, to figure out what you can do is do a calculation to figure out how long it's going to take you through having a higher retirement allowance to get all that money back that you're using to make that service credit purchase. So you look at your letter that we sent you that has how much it's going to cost to make the service credit purchase, and you will take that purchase cost and you divide it by the monthly difference, and that's going to tell you how many months it's going to take to get your money back. Okay. So, I can't think of an example off the top of my head. Let me just say that once you do this calculation, and it tells you, and you know how many months it's going to take you to get the cost back, you can also, again, divide that by 12, and that will tell you how many years it's going to take to get your money back. So maybe it's going to take, after you do the calculation, it's going to take, a year to get the cost of purchasing the service credit back through increased retirement allowance payments. Or maybe it's going to take 5 years or 7 years. And then after that, once you get all the money back, you have a larger retirement allowance for the rest of your life because you thought ahead and you made that service credit purchase. Maybe if it's going to take 20 years to get all that money back, maybe it's not so worth it for you. Okay. So that's kind of how you figure it out. Sorry about that. Is you look at, you just kind of look at how much it's going to cost. You figure out how long it's going to take for you to get that money back. Okay. And so that is service credit. Let me see if I have any more questions about service credit before I move on. There's a question, is the PowerPoint available to us after this meeting? It's actually already up on our website on our seminars page. I will need to update it after this because I did update a couple of the numbers right before this seminar, but I'll do that update later today, right after the seminar. Okay, here's a question. When you buy back time, do you pay the rate according to your salary back when you were on the leave without pay? Yes. Or do you pay the rate according to your current salary? Nope, it's back when you would have been contributing to the system. So if you're trying to buy 3 months of unpaid medical leave from 5 years ago, you're probably making a lot less money 5 years ago, and it's going to be your rate of pay, your contribution rate, times your amount that you were actually getting paid back then. Okay, does all on-call pay or standby time count as retirement? Or is that the same thing as service time? When you're on-call time or standby time, so you'll see that on your pay stub, a different line for on-call pay and standby pay. That does not count toward retirement. That pay doesn't count toward retirement, and that time, if it's time that's outside of your regular working hours, that does not count toward the service credit part of retirement. Now, if, having said that, so it would be like if you're getting on-call pay during your regular working hours. So let me say it a different way. You get service credit for your regular hours worked, okay? And anything beyond that, you don't get service credit for. Okay, I think I might have deleted a question by accident. Let me see. Or answered it by accident. So yeah, if your question isn't still up on the board and I didn't answer it yet, feel free to type that back in. And then it looks like all the rest of them are about reciprocity. Okay. Thanks for bearing with me for just a second. Okay, so we talked about the age factor percentage. We talked about service credit and purchasing service credit. Let's talk about the salary component of the retirement formula, the highest average monthly salary. So what are we looking at when we go to calculate your highest average monthly salary? Well, what we need to do, and what the law tells us that we have to do, is that we have to find your period of highest pay during your career when we go to calculate your retirement. That is known as your final compensation period. And it's your period of highest consecutive pay. So for tiers 1 and 3, it's your highest consecutive 26 biweekly or 12 monthly pay periods. For tiers 2 and 4, it's your highest consecutive 78 biweekly or 36 monthly pay periods. So it's depending on if you're paid biweekly or monthly, which types of pay periods we're looking at, but it is consecutive pay periods. So for tiers 1 and 3, essentially we are looking at your highest 1 year of pay. For tiers 2 and 4, we are essentially looking at your highest 3 years of pay during your career, at any point in your career. So we're going to go back and look at your entire payroll records because we have all those in our database. Now, what we do is, in order to get that factor in the formula that we need your highest average monthly salary, we're going to simply look at your period of highest pay. We're going to look at the total amount of money you made during that period and divide it by the number of months in that period. So for tiers 1 and 3, we're dividing your total pay by 12 months, your total highest year of pay by 12 months to get your highest average monthly salary. For tiers 2 and 4, your total pay made over your highest 3 years of pay divided by 36 months is how we get your highest average monthly salary. So the types of pay that are included are base pay, of course. So your base pay that you're getting paid is going to be included. And and this pay is always gross pay before any amounts are taken out for anything. Some footnotes and other pay codes may be included. And I can't tell you off the top of my head which types of other pay codes are included. Footnotes are other types of pay based on skills and education. But you can look it up for yourself. If you go to acera.org/pay codes, or you just search for pay codes, there will be a list there for your employer of all the pay codes, and it'll say yes or no, whether it's included in the calculation or not. But I can't tell you that overtime never counts. And if you need more information on how to find your pay code on that sheet, you can ask your payroll manager to help you find it. And then for tiers 1 and 2, also some vacation sales and some vacation cash out can be included. So this is money that where you're selling your vacation back to your employer while you're still employed is vacation sale, and cash out is when you have vacation left over on the books and you stop working. They will pay you out for it at that time. And some of that money can be included up to a limit. I'm not going to take a deep dive into that topic in this presentation. If you want to learn more about that, you should attend our pre-retirement webinar, or you can just watch one of the videos that we have out on our website of the pre-retirement webinar. And we do talk about that topic extensively. But that does tier 4 people, when the state created tier 4, they excluded that type of pay. So for you all, it'll just be base pay and footnotes and other pay codes. Okay. One more thing I want to talk about regarding salary and calculating your retirement is the tier 4 members. And this is the slide that I updated this morning. There is a limit for tier 4 members on how much annual salary we are allowed to consider for the purposes of calculating your salary component of your retirement formula. So for general members, we are limited to looking at $134,974 of annual salary in terms of including that for calculation in your retirement. For safety members, it's $161,969. These amounts go up every year. There's some Social Security calculation, that some federal government calculation that tells us what these limits are, but these are the limits. And the way it works is that, like for a general member, for example, if you were to earn more than 100, if your annual salary is higher than this, whatever point in the year that you earn this amount, then that is when we stop taking retirement contributions out of your check for you on an annual basis. So that actually leaves you more money. I mean, we can't include that any more salary than this for the purposes of calculating your ACERA retirement, but that does leave you more money in order to be able to save additional money for your in your 457B account or your personal savings. So that's how that works. There's more information about that at acera.org/limits. And then, yeah, so on-call pay, what you're going to have to do is you're going to have to check on-call pay probably does not count. Or actually, no, I actually don't know whether it counts or not. I'm not going to tell you yes or no whether it's in or out, because I actually don't know. So sorry that I'm saying things that I may not know the answer to. What you need to do for on-call pay is go to acera.org/pay codes and look up your pay code number for your employer and see if it's included in the calculation. It may actually be included in the calculation. So yeah, sorry to be confusing about that. Okay, and then one last thing about calculating your retirement is to give you an example. So this is an example of everything put together. This tier 4 member is retiring at age 65 after earning 25 years of service credit. So that means that because they're retiring at age 65, their age factor percentage from the chart is going to be 2.30%. We're going to multiply that by their 25 years of service credit. We're going to multiply that by their In this example, they have a $6,000 highest average monthly salary, and that tells us what their monthly retirement allowance is. Now you can see there's a lot of decimal places here for the years of service credit. That's because we calculate your years of service down to the fraction of a day. So when you look at your service credit number, there will be a lot of decimal places after it because you're earning service credit like every 15 minutes you work. So you're getting all that service credit all the way up until you stop working. But in this example, they earned exactly 25 years of service credit. And so you can see in this example, if we multiply the age factor percentage times the years of service, they are actually achieving 57.5% salary replacement. So remember back to that slide I showed you at the beginning of the presentation where kind of your goal is 70 to 80% salary replacement in order to maintain your standard of living. They're getting 57.5 salary replacement, which is actually really good from the ACERA pension alone, because there's also going to be Social Security is going to be in there, and that is going to get them more, like a lot higher toward that 70 to 80%. Okay. Let me answer this question real fast. Does the Tier 4 cap apply now? So if we make more than the cap, do the contributions stop each year once the cap is reached? Yes. So that is actually a good thing because it keeps you from contributing more than we're using to calculate your pension. And so you have more money to save, and your additional savings are 457B account. Okay. We talked in general about how your benefit is calculated. Let's talk specifically about how you can get an estimate of what your future retirement allowance is going to be. What I'll help you do is kind of look into the future and get a picture of what your future retirement income might be. So I'm going to show you two ways to do that. The first way is a super quick kind of ballpark estimate that shows you what percentage salary replacement you will achieve in different scenarios. And you do that by going out to our website and going to the Planning for Retirement page. So I'll start over at our homepage. And if you go under members and you go down to planning your future retirement income, and you scroll down, step one is getting an ACERA estimate, and it gives you 4 ways. The first way is this way that I'm showing you right here, which is just a quick way to get a ballpark estimate. So for example, I'll click on the Tier 4 General Members button, and what you'll see is a table for each one of the tiers. And across the top axis, it has different ages that you might retire at. Across the y-axis has years of service credit that you might have earned by the time you retire. And so there's probably going to be a place where these intersect for you in your retirement scenario, and there will be. And so if you think, okay, I'm going to maybe retire at age 60, and then you think about how much service credit you've already earned, then you can, like, I've already earned, let's say I'm age 50 and I've already earned 10 years and I'm going to retire in 10 years at age 60. That means I'm going to have 20 years of retirement of service credit. So then I'm going to find out where those two intersect. Okay. So so with 20 years of service credit at age 61, I will receive 38% of my salary as my retirement allowance. Okay. And then what you can do once you've found where those intersect is then you can proceed diagonally. So if you work another year, you're going to be another year older, you're going to be age 62, and you're going to have another year of service credit. So that would get me 42% of my salary as my retirement allowance. If I work another year, 46.2%, another year, 50%. Okay. So you can just kind of go down diagonally and you can see what working additional years would get you in terms of your percentage of salary replacement. So that is the first way of getting just like a quick estimate of your future benefit with ACERA. The second way, and this is a screenshot, these are screenshots that I'm going to show you, is the second way is to go out to our website and click the login button. And once you click the login button and you get into Web member services, which is our member portal where your account exists, you'll see an account summary in there. And it will have a lot of your pension data that we have in our database for you, like your tier, your employer, whether you have reciprocity or not, your date of employment, your entry date, how much service credit you've earned, how much you've contributed. So there's a lot of stuff in there to check out. What you're going to do is click on Estimate a Benefit. Okay. And once you click on Estimate a Benefit, you're going to see this benefit estimator that I already showed you one screenshot for earlier. And so I'll just zoom in on it so you can see it a little more clearly, because I know everything's kind of tiny on the screen. What you're doing to get this benefit estimate is you're thinking of a future retirement scenario, like I'm going to retire 10 years from now, and you just pick a date. Unless you're going to retire really soon and you happen to know what date you're going to retire. Otherwise, you're just kind of, picking a date that kind of meets that future scenario. So in this example, this person is retiring. Their last day of work is March 15th, 2030, and their projected retirement date is the next day on March 16th, 2030. The projected retirement date has to be at least one day after the separation date, but it could be more. If you are not going, in this example, this person is going straight from active work into retirement. If you're not going to do that, if you're going to stop working and defer your retirement to a later date, there might be a big gap here. Like maybe you are going to stop working in 2028, but not retire until 2030. You can do that scenario as well in here. Okay. And just really quickly, when you do that, you become what we call a deferred member. So when you're working, you're an active member. When you're a retired member. If you do have a gap between active work and retirement, we call you a deferred member because you've stopped working, but you've deferred your retirement to a later date. Okay, that information will be helpful later on in just a few minutes. So for now, I'm helping you estimate a benefit, and you put in your retirement scenario and you hit calculate. And what it does is it projects the amount of service credit you will have earned in this scenario, because you've already earned some, we saw on the summary screen. And so what it's going to do is it's basically going to take you into the future. And if in this retirement scenario, you will have earned this amount of service credit. It will also do a salary projection for you. And this is based on your current salary. Okay. Or really what it's based on is your highest salary that we have in our database for you. And you do have the opportunity to override those numbers, so that you can override the service credit like I showed you earlier by increasing it. You can override the salary if you want to by increasing it. If you're not going to retire for 10 or 15 years and you want to see what the effect of 10 or 15 years worth of cost of living adjustments that your employer is probably going to provide you, you might want to increase your salary here just to see how it would affect your retirement allowance. I recommend leaving this blank and adding hours of cash vacation compensation unless you understand that topic by reading our page on that, sarah.org/vacation, or watching our pre-retirement seminar. Otherwise, just leave that blank. And then you can put in beneficiary information here if you want to. If you've already designated a beneficiary for your active death benefits, you may see them in there. So you can go ahead and select them, make sure their date of birth is correct, and then click Get Estimate. And what you end up with is this retirement benefit estimate PDF. We're actually currently redesigning this, so it might look a little bit different when a little bit later. But this is what it looks like for now. This is your benefit estimate for this scenario that you just did. So it has up here some info about your membership and the information it's using to calculate this estimate. And then in this box right here is the actual benefit estimate. So I'll just zoom in on the info here so you can see it a little bit better. What you're going to want to look at is this number right here for now, the unmodified option, because this is the option. It's giving you an estimate for the different options that you'll have at the time of retirement. But since you're new employees or in your mid-career, you don't really know what your option you're going to pick, I would assume, until it gets closer toward retirement. So you can just kind of look at the unmodified option, which is what the vast majority of people select anyway. And that is your retirement estimate. The unmodified option pays the highest of any of the other options. And so that is the estimated amount that you're going to get every month for the rest of your life in this scenario. Okay, so that's how that works. So that's two ways to get a projection of your future ACERA retirement benefit. Now, let me help you understand your retirement eligibility, because if you recall that retirement eligibility is one of your pension milestones. So you can't actually retire before that. You have to be eligible to retire under the rules set forth in the state law in order to be eligible. And like I said, it's based on some combination of years of service credit and age. So let me show you the requirements for tiers 1, 2, and 3 first, and then I'll do tier 4 second, because they're a little bit different. For tiers 1, 2, and 3, if you meet one of, you kind of have three options for becoming eligible to retire. Option number 1 is you're age 50 or more, you're at least age 50, you have at least 5 years of service credit, and you have at least 10 years of membership with ACERA, and you can retire. And if you'll note, that includes service credit purchases and redeposits, and it also includes reciprocity. Okay, so it also includes reciprocal service. The service credit, the difference here, I'm not sure why they did that, why they set the law up that way. It doesn't make any sense to me, but you do have to have at least 5 years of service credit. If you're going to go straight into retirement, you kind of want to think about it as, I have at least 10 years of service credit, and I'm at least age 50, and then I can retire. But you don't have to. Under option 1, you could work 5 years, quit, just wait another 5 years until you have, as a deferred member, and you have 10 total years of membership, and then as long as you're over age 50, you can retire. Okay, option number 2, you can have 30 years of service credit as a general member or 20 years as a safety member and retire at any age. Option, even if it's less than age 50. Option number 3 is you can retire at age 70 with any amount of service credit, even if it's less than the 5 years that you need under option 1. So those are your 3 options. Okay, now for tier 4 members, you have 2 options. Your first is that as a general member, you have to be at least age 52, and as a safety member, you're at least age 50, and you can retire with 5 years of service credit. So you don't have to do that 10 years of membership thing. It's just 5 years of service credit and be over these ages. Or you have that other option of being age 70 and retiring with any amount of service credit, even if it's less than the 5 years you need for option number 1. So that's how you become eligible to retire. Once you're eligible, you can go ahead and retire, or you can stick around and you can earn more credit toward retirement. Okay, let me talk really quickly about other benefits. So we have some other benefits that we offer, including medical, dental, vision, and other non-guaranteed benefits. There's disability retirement, and then there are death benefits. Okay, so regarding medical, dental, vision, those are not guaranteed benefits. Okay, so if you recall seeing the list of guaranteed benefits, that's the retirement allowance, the cost of living adjustment, and that $1,000 lump sum death benefit. These are extra benefits that the county decided ACERA retirees needed to pay for their lives in retirement. So they started a reserve fund back in the 80s to pay for the cost of these extra medical, dental, vision, and other benefits. And our Board of Retirement runs this reserve fund. Their whole goal is to ensure the fund's sustainability. So they monitor how much money is in the fund, what levels of benefits that we're paying out, and they may make adjustments here and there to make sure the fund stays sustainable so that we can continue offering medical, dental, vision benefits. Now, currently, it's considered very sustainable. There's over $1 billion in the fund. So it's not really, the sustainability is not really something to worry about. But the reason that I wanted to show you, and I'm not going to take a deep dive into these benefits because the costs change over time. Everything kind of shifts over time because, it's private insurance companies we're dealing with. But what I do want to do is show you the years of ACERA service credit that our Board of Retirement has set up in order for you to qualify for these benefits, because this is important to know as a new employee and in your mid-career in terms of planning your future retirement. You can see that there's one benefit here, the supplemental cost of living adjustment, which is on top of the vested cost of living adjustment, that you don't need any years of ACERA service credit to qualify. All the other ones start at 10 years, okay? Medicare subsidy, vision, dental subsidy, And the MMA stands for monthly medical allowance, which is our medical subsidy. And there's actually 3 levels of that. You can get higher levels if you stay for 15 or 20 years. But they all start at 10 years. And the reason I want to show this to you is to illustrate the idea that maybe you've already been working here for 9.5 years or something. Okay. And you're thinking about going and doing something else. And you're going to, retire from Acera, or you're going to retire later, whatever. You may want to stick around for another 6 months, get over that 10-year mark, because the amount that is provided in these Medicare, vision, dental, and this base level of the medical subsidy is a lot of money in retirement that you would get additionally just by getting over that 10-year mark. So the 10-year mark is kind of something to shoot for. I would consider. And so that's basically the extent of what I want to talk about with these non-guaranteed benefits. But I will add that 10-year mark to our pension milestones chart, just because I think it's pretty important thing to be cognizant of. And one more thing I want to point out, going back one slide, this is years of Acera service credit to qualify. This does not include reciprocal service credit. Okay. It does include service credit purchases, but it does not include reciprocity, reciprocal service credit with another agency. And then I have a question up here. So just to be sure, for tier 2, you can be any age with 30 years of service. Yes, as a general member. And the scenario there is you started working at 18, you worked until age 48, so for 30 years, you have 30 years of service credit, and yes, you can retire a couple of years early before you reach age 50 under tier 2. Yep, as a general member. For safety members, it's 20 years. Okay, let's talk. So this is kind of a subtopic of the benefits. This is about death benefits. So let me help you designate your beneficiary or beneficiaries and keep them current. And there's a question, is tier 4 eligible for retirement medical benefits? Oh yeah, this is all the tiers. Okay, so all the tiers are eligible for these benefits. You just have to get this amount of, at least these amounts of Acera service credit to qualify. And then there's a question, does the benefit only increase at 10, 15, and 20-year marks? There's no proration. Correct. There's no proration. So if you're, like I said, if you're at like 15 and 3 or 14 and 3/4 years, you might want to get over that 15-year mark before you leave, because there is no proration. Okay, your beneficiary, that word just means somebody who gets benefits. Now, your Acera beneficiary is the person who you designate to get your Acera death benefits after you pass away. Okay. So what I'm going to tell you about are death benefits before retirement, because there's a whole different set of death benefits after retirement that come with the different retirement options. We get into that in the pre-retirement seminar. What I'm talking about here is, should you die before retirement, there are death benefits available for your beneficiary or beneficiaries. Okay, so first of all, for non-vested members, if you should die before you are considered vested in the system with 5 years of service credit, what your beneficiary would get is a return of your employee contributions and interest. So basically, the balance of your employee contribution account, they would get that back. Plus, they would get 1 month of salary for each year of service, up to 6 months worth of salary. Okay. So if you had worked for 4 years, then they would get 4 months worth of your salary in addition to the return of employee contributions and interest. Now, if you're vested, once you've passed the vesting mark with 5 years of service credit, your beneficiaries receive a choice. They have expanded options. Option number 1 is the same. They still have that option. It's the same one. They also have options 2 and 3, and it says to qualified beneficiaries only. I think this is spouse, state registered domestic partner, and minor children. But you can check that out on our death benefits page to see who qualifies there. They would get a monthly survivor's allowance as option number 2, and that would be for the spouse and state registered domestic partner for the rest of their life. I think for the minor children, there's a cutoff once they reach a certain age. And then option 3 would be 1 month of salary for each year of service, and then a reduced survivor's allowance. So it's kind of like a combo of option 1 and 2. Excuse me. Option number 2 is based on a calculation of what your retirement would have been had you retired when you died. And then what they do is they pay, it's based on the unmodified option. So then they pay the beneficiary 60% of the retirement earned up until the date of death. And that becomes the beneficiary's lifetime allowance. Okay, so then if you're a deferred member, remember I said that if you're an active member, you're actively working. If you're a retired member, you're retired. But in between, if you stop working but don't retire yet, you're deferred. That you don't get any of the other options. It would just, your beneficiaries would get a return of employee contributions and interest. Okay. So let me see, I have a few questions here. Okay, so the question is, if I worked full-time for 5 years, had kids, and returned half-time for 10 years due to the kids, the equivalent of 5 years, am I allowed to purchase service credit of the 5 years to total 15 years? I don't think so. I've never heard of that. I think that if you're working part-time, you're just part-time and you're just earning at a service credit at a slower rate. You can feel free to confirm that with our customer service team, but I'm like 99% sure you can't purchase. You wouldn't be able to purchase that other portion of the part-time work. But definitely check with our customer service team, because I could be wrong. I'm wrong about stuff all the time. Okay, so next question, this is a follow-up, or is the purchase credit only for the unpaid medical FMLA leave? Yeah, I think if you don't see it on that list that I showed you, if you don't see the type of time for service credit purchasing on the list, then it's not purchasable in general. So yeah, that's the complete list of times that are eligible for purchase. Okay, next question. Okay, to clarify, to be eligible for retirement after 30 years of service at age 50 means that you can retire from the county, but that you wouldn't be able to actually receive retirement benefits tax and penalty free until full retirement age. So when you use the term full retirement age, I think you're probably thinking of Social Security. They're a totally separate system with a totally separate set of rules. What I showed you here, and here, these are ACERA's rules. So your full retirement age is whenever you choose to retire. So if you retire at age 50, that's your full retirement age in terms of ACERA. So you're going to get paid your full retirement allowance starting at age 50 when you retire, if you were to retire at age 50, and every month for the rest of your life. We don't care what Social Security is doing. You're going to become eligible to collect Social Security at some later date. That's fine for them. But in terms of ACERA, your full retirement age is when you retire. So I hope that clarifies that. Let me know if it doesn't. And then there's a question, are we able to see the employer contributions into retirement? Are the estimates including contributions from the county? So you can see the, the way that you kind of figure out how much the county is contributing is there's a link on that employee contributions page to go to a page that we talk about employer contributions, but it doesn't really matter because the employer contributions don't matter. They're not, first of all, the contributions are not one of the factors in the retirement formula. So if you're going to retire from ACERA, the amount that you've contributed doesn't even matter because it's not one of the 3 factors in the formula. If you are going to quit and take a refund of your contributions, the employer contributions are not refundable. They always stay with the system. So, I mean, if you go to our contribution page, you can see how much the employer is contributing, and it's more than what you're contributing, but it doesn't matter a whole lot. And then you had a question, are the estimates including contributions from the county? I mean, the estimates, the estimate that you're getting for your retirement allowance, the contributions are not being figured in there. That's not one of the factors in the retirement formula. The way that we calculate how much contributions to collect from our members and from the county is we have an actuary figure out based on how many members we have and who our members are and what their projected retirement estimates are going to be. We need to collect that amount of money, figuring for how much we're going to earn in interest in order to have the money to pay the benefits. So that's how we figure out how much the contributions are. It's a super complicated, it's actuarial science. It's like super complicated, but that's how we figure out the contribution rates. Okay. So, and sticking with one more thing about the death benefits. If you want more info on the death benefits before retirement, you go to acera.org/death, and that's our death benefits page. But keep your beneficiary designations current. So as active members, you can change your beneficiaries at any time. As deferred members, if you're a deferred member from Acera, you can change your beneficiary designations at any time. And the way you do that is with our beneficiary designation form. So if you go to our forms page, you'll see an active member, I think it's an active deferred beneficiary designation form. Let me check on that. Let me help you out here. Okay, here's acera.org, forms and publications, forms. Okay, active or deferred member beneficiary designation form. Like I said, this is not going to be this anymore. This is going to be a DocuSign thing pretty soon, but this is what it looks like. And this is how you change your beneficiary. So you just fill out that form and you send it in to us. And as soon as we receive it, your beneficiary is changed. And you're going to want to check your beneficiaries, log into your account. There's a whole page on beneficiaries, see who they are. If your beneficiary, once you get in there, is your spouse from 3 spouses ago, you're going to want to go ahead and change your beneficiary because you don't want us to pay the wrong person when you die. And this beneficiary designation supersedes will, an estate, anything. This is whoever you designate your beneficiary, that's who we're paying. Okay. Oh, here's a screenshot of the beneficiary page. You just click on nominated beneficiary and it shows you who your beneficiaries are. Okay, let's see here. We are running a little over time, so I'm just letting Gene Hilliard know that he's the presenter for the 457B presentation. So we're going to probably be another 10 minutes before we can start that. So we might go a little like 10 minutes over time. If you all need to go, feel free to leave when you need to. And we will, like I said, we'll post this video on our website within the week so you can see the end of it. Okay. Let me help you. We're down to the last few things on our checklist, understanding career planning options. And this is when I'm going to get into the reciprocity discussion. Okay, so you have options for you in terms of planning your career with your employer and in terms of planning it with your Acera membership. Okay. Now, your first option is always to work straight into retirement. So that is what we've been talking about. You're earning credit toward retirement, you work through your career, and then you retire and you collect that retirement that you've been earning. Okay. If you do that, you're earning service credit right up to retirement. Like I said, we will actually convert half of your sick leave into service credit if you go straight into retirement. You can even go work somewhere else if you want, and we're going to consider you retired and give you your lifetime retirement allowance for the rest of your life. And you can get your Acera retirement at the same time. Okay. Now, kind of your second option, rather than working straight into retirement, some of you may want to terminate before retirement. Okay. So this is where you are becoming a deferred member, perhaps. So you're stopping working before you're ready to retire. So there's going to be a gap between your date of termination, so your last day on payroll, and your first day of retirement. So I'm going to go ahead and edit the pension milestones chart to add the terminating employment date if that applies to you. And in that case, you will earn service credit between your date of entry, and the date that you leave. So as soon as you stop working, you stop earning service credit toward retirement, even if you're retiring at a later date. Okay, so just to be clear on that. Now, regarding leaving before retirement, you have three options, and I will call them, because we've already done 1 and 2, I'll call them options A, B, and C. Okay. Option A is deferring your retirement. This is becoming a deferred member. And when you defer retirement, what you're doing is you're maintaining your SARA membership, but you're not retiring yet. Okay. So this means that you have stopped working, but you're not going to retire yet, and you're leaving your contributions on deposit with a SARA, and you're still an SARA member. Okay. As a deferred member, because you have a balance in your contribution account, you've left your contributions on deposit, we continue to pay interest to your account. And in fact, we don't pay negative interest. And people ask me what that means. That means that you don't ever lose money. You cannot lose money. If we experience adversity on our investments, then, and we lose a little bit of money temporarily, we don't take any money out of your account. Your money is perfectly safe. It's just that maybe for that period, you don't earn any money. We don't post any interest, or we don't post as much. But your money is absolutely safe. And there's really nowhere else you can park your money that earns the kind of interest that we earn, where there's no risk in losing any of it. So it's kind of amazing. You can even retire later out of deferred status. Okay. So you stop working, you're a deferred member for a while, and then you can retire later. Or you can come back to work and earn more money. So you can, if you get another job, you can start paying into the retirement system again and earning more credit toward retirement. Or you could be refunded at any time. So you could start out as a deferred member, maybe a year goes by, and then you decide, I really want to take a refund of my contribution account. You always have the option to do that in the future. Okay, so that's option A. Option B is establishing reciprocity. So this is going to go to answer a lot of those questions that you all were asking at the beginning of the presentation. Establishing reciprocity is where you're linking different public retirement systems together. So many of the cities in California, most California state jobs, except for jobs in the UC system, the University of California system. Also, any agencies that use CalPERS. So some agencies will contract with CalPERS, which is the state retirement system, in order for their members to be CalPERS members and earn retirement through CalPERS. So any agency that uses CalPERS, we have reciprocity with, and there's a full list on our website. So what you're doing is you either used to have a job for one of these systems, and you can link it with a SARA once you come to a SARA, or maybe in the future you go work for another system and then you can link a SARA with that other job. Or you can hop around to a bunch of employers and link them all together by establishing reciprocity. The benefits of reciprocity are that the service credit that you earn under all of the systems combined gets you over the vesting and retirement eligibility requirements. And I was referencing this earlier. Okay, so we can just move on from that. The second benefit is that the highest salary earned under all of the reciprocal systems, under any reciprocal system, is used by all of them when they calculate your retirement. So in that Marin County example, where you started out working in Marin County and now you work for Alameda County, for, let's say, and so you're a SARA member. When you go to retire, presumably at this job, because you've been here for a while, or maybe you got a pay increase when you came over here, you're earning more money here. So when you go to retire, Marin County is going to do a calculation for you based on the service credit that you earned over in Marin County, based on the age factor percentage for their tier over in Marin County. But then when they get to the salary part, they're going to call a SARA and they're going to say, what's the highest average salary? We're going to tell them if it's higher than what they have, they're going to use the salary that you were earning under a SARA to calculate their calculation for you. Okay, and then of course for a SARA, we're going to use your service credit you earned here, your age factor percentage from your tier here, and your highest salary here. And we both will do a calculation for your retirement benefit, and we both send you separate checks. Okay. And then the third benefit is it keeps your contribution rate lower. If you are in one of the earlier tiers, and it could put you in an earlier tier. So if you entered the first system before the cutoff for tier 2, and then you establish reciprocity and come over for Sarah, we're going to put you in tier 2, okay, and not in tier 4. Okay, so in order to qualify for reciprocity, you have to do 3 things. You have to defer, which is leave your contributions on deposit with Sarah. And in fact, each one of the systems that you are maintaining your membership in and linking together, so you cannot take a refund of your contributions. And no more than 180-day gap can happen between the termination date from the one job and the entry date into the next system. Okay, so it's about 6 months. So you can't have a bigger gap than that and be able to establish reciprocity. We also don't want to have any overlapping service. So don't go on a 5-week vacation here and immediately start another job, because then you're doing service, you're on payroll in 2 different places at the same time, and that will disqualify you from establishing reciprocity. And then you have to retire from all the systems on the same day. Okay. And then so there's a question, how do you establish reciprocity? How would you link Marin County and Sarah, for example? That is something that you would have done when you filled out your member enrollment questionnaire, when you're in your orientation for Sarah. And so you would have written down that you used to about your previous employment, and we would have established reciprocity for you. If that didn't happen and you log into your account and you think reciprocity should be established, or you want it to be established, and you log into your account and where it says reciprocity, it says no, that means that you haven't established reciprocity, then go ahead and contact us and we can get that set up for you. Okay. And then there's a question, is San Francisco State University a Sarah? Maybe you mean, do we have reciprocity with San Francisco, the state university system? I'm not sure. You would want to check our reciprocity page, and it probably says on there whether we have reciprocity with the state university system. Okay. So let me see if I answer all the previous questions. So what happened? The question was, what happens if you had PERS before coming to Alameda County? Do those years combine? Now, if there is less than 180-day gap between PERS and Alameda County, then you can establish reciprocity and link the systems together. If there's more than 180-day gap, you cannot establish reciprocity. But if you earn enough credit over at PERS, you can maintain, and we're talking about CalPERS, which is the state's system, you can maintain your membership over there, and they will still do a retirement calculation for you when you retire from them. You don't have to retire from them on the same day as a Sarah, because you don't have reciprocity. You just have to meet their whatever eligibility requirements they have. But if you are able to do that, then I would recommend it, because usually retiring from a pension system gives you a pretty powerful benefit. Okay, and we already answered that. Okay, we answered that. Okay, now there is a question, is CalPERS transferable service credit? So yeah, like if you're not ever going to be eligible, if you worked for CalPERS, you're not ever going to be eligible for their pension system because maybe you're never going to be vested, then it might make sense to go ahead and do a refund of your contributions from their system in order to help you pay for buying that time as a Sarah service credit. But if you are going to be eligible to collect from CalPERS, I recommend leaving the money there and just retiring from CalPERS whenever you get the chance. Okay. Okay, so that's options A and B. Option C is where you are not becoming a deferred member. You're not establishing reciprocity. You just want your money. You just want a refund of your contributions. That's totally fine. You always have that right. We are holding your contributions in your contribution account. We're paying interest on top of it. We're keeping track of all that money for you. Okay. So if you do stop working and you do want to take a refund, you can. You may lose up to 1/3 of your money due to taxes and penalties, because you will have to pay income taxes on that disbursement because we collect it on a pre-tax basis. the contributions. And if you're before, I don't know what the age cutoff is where you don't have to pay the penalty, but there is a penalty for early withdrawal from a retirement fund. It's a state and federal penalty. And so if you're just looking for cash, you may lose a third of your money between taxes and penalties. Now, if you want to roll over that money into another type of pre-tax retirement account listed here, you can do that without the taxes and penalties. Refunds take 45 to 60 days, can take longer. It's not an instantaneous thing, so that's something to be cognizant of. And basically, you're waiving your rights to all ACERA benefits, and you're saying, I don't want to retire from ACERA. I don't want to receive the retirement allowance for the rest of my life. I don't want to have access to the healthcare subsidies. Just, cash me out. Give me the money. So it's totally fine. Now, let me advocate for maintaining your ACERA membership. Remember earlier at the beginning of the presentation, I said, if you do retire from ACERA, you're eligible to retire and you do retire, you will get all that money back. Remember how long I told you it would take to get the money back? The first 3 to 5 years. So in the first 3 to 5 years, if you retire from ACERA, you're going to get all this money back anyway through retirement payments. And then after that, you're going to be paid for the rest of your life. So in most cases, it does not make a ton of sense to take a refund of your contributions and interest. Okay, let me see. We have a question. If you establish reciprocity with Marin and you worked in Marin for 15 years and you worked in Alameda for 5 years, will Alameda use 5 years in the calculation? Yes, you have that correct. So Marin would use 15 years of service credit in their calculation. Alameda County, ACERA would use 5 years. So yes. Okay, this is our last big topic. And I'm just going to go through this quickly so that I can let Jean talk to you about the 457B plan, but these things kind of work interconnectedly. So we've talked about the ACERA monthly pension, and we talked about how we're trying to get you aimed at 70 to 80% of your working salary as your retirement income. Gene is going to come on and he's going to say he wants to get you up to 100. Okay. And so you're going to earn your ACERA pension, you're going to earn Social Security in most cases. And then anything beyond that, your income is going to be based on your savings and investments. So in order to kind of reduce the stress of what that might look like in the future, let's go ahead and paint a picture of that right now. We can just get some estimates and do some calculations, and we can just get you on track to getting you pointed in the 70 to 80% direction. And it's actually not that complicated. Step one is you get some estimates. So you get your ACERA estimate. So go use our Benefit Estimator, get an estimate. The estimate is going to tell you that you're going to get a certain amount of dollars per month at a certain age. Then you're going to want to go get a Social Security estimate at their website. They have a really powerful calculator that you can use. You log in as you, and you can use their calculator. To get the ACERA estimate, like I showed you, you use our Benefit Estimator. You end up with the ACERA benefit estimate, and you take this number right here. And I don't think you need these numbers anymore, actually, with the way we're doing it. You're going to want to know what age you are in this estimate, okay, in this way of doing it. So get a piece of paper and just like write down your ACERA estimate from the Benefit Estimator and what age you are in your retirement scenario. And then get a scenario from Social Security for maybe that same age. And for Social Security, what you're doing is you're going out to their estimator, and you're going to end up with an estimate that looks something like this, where they're showing you 3 different ages and you have 3 different dollar amounts, okay, that you would get from Social Security every month for the rest of your life from their system. And then you can write those on your piece of paper, okay? So what I'm going to show you is, since we know what we're starting to paint a picture of what your ACERA income is going to be and what your Social Security income is going to be. Let's see how we can fill in the gap in terms of personal savings to get you pointed in that 70 to 80% direction. And you can do that by using one of these retirement calculators online. There's a bunch of them. I recommend trying multiple ones. Gene is going to show you the Prudential Retirement Calculator when he is doing his presentation, but they all give you kind of a different number, but it'll help get you pointed in this direction. I'm going to show you the Vanguard calculator right now. And instead of doing screenshots, I'll just go out to the Vanguard site and show it to you. These are just public calculators that different companies provide as a free service to help you calculate your retirement. Presumably because they want you to invest with them, but you don't have to do that. You can just use their calculator. So we're going to go under members, planning your future retirement income. And this, if you want to spend more time doing this, this is actually a page that gives you step-by-step instructions. What I'm kind of going over quickly, this gives you way more details. I recommend spending a little time with this page, and this takes you step-by-step through what I'm doing. I'm going to scroll down to step 4 and click on the Vanguard calculator. And what it is it's going to ask you some questions up here, and then down here it's going to do a chart that will help get you pointed in the direction of having adequate retirement income. So I'm going to do a scenario. We're just picking a random scenario here. Let's say, let's stick with age 62. Let's say that I'm 35 years old and I plan to retire at age 62. Let's say I make $70,000 a year. Okay. And I save, how much do I save per year? We're going to leave that at 0 right now, because this is where we're going to make our adjustment later. Okay, I've already saved how much for retirement? Well, let's just stick with 0. Let's say you haven't saved any. That's totally fine. If you haven't saved any for retirement so far, totally fine. We'll get you saving a little bit starting right now. Okay, let's change this to 80%, because this should be, you can play with it if you want to, but we'll pick a number between 70 and 80 just to start off with. We'll say that you're aiming for 80% income replacement, which means that your income in retirement needs to be 80% of what it was while you were working. And this number right here, the annual return number, and you're asking, when you say what you make, is that net? That's gross. Do you use gross salary? And then for your annual return, this should be a number between 2% and 7%. Okay, I'm going to choose 6%. 2% is super conservative. You can find stuff that is almost absolutely safe where you won't ever lose any money for 2% annual return. But what you're losing out on is kind of the power of compound interest. If you put your money in places where you have the opportunity to earn a little more interest, like you have a diverse portfolio, then you can kind of get a little more and kind of earn more through the power of compound interest. So a good number to kind of aim for is between 2 and 7%. You can ask Gene more about this whenever it's his turn. I'm going to put in 6% to be kind of conservative. Here, if you click on additional income sources, is where you're going to want to put in those estimates from Social Security and ACERA. So it was about $1,700 from Social Security and about $2,300 from ACERA. Okay, so then you hit calculate, and it's going to show you this chart. This amount right here is how much. This is how much you're going to need in retirement. It's calculating how much you're going to need in terms of monthly income in retirement. Okay, and it's showing it to you in this bar graph. Now over here in this bar graph, this is how much you have based on the numbers you already put in. The Social Security is this bar here, and stacked on top of that is the pension benefit. You can see that there's a gap here. You're not quite able to get up to how much you're going to need. You have less than what you're going to need. So you're actually going to need to save some more money in this scenario. So what I'm going to do is I'm going to scroll back up and I'm going to put in a savings amount. Let's say that I save $400 annually. Okay. We're going to see what that does to get me to closing this gap. Okay. It didn't move very much. So what I'm going to need to do is I'm going to need to go way over that. So let's see what happens with $7,000 per year. That's about 10% of the income here. Okay, overshot it. Okay, so I don't need to save that much. Let's go down to 4,000. Okay, now I'm a little bit under. I'm getting close. I have 4,500 and I'm going to need 46. Let's see what happens if I do 4,800 and I'll recalculate it. Okay, now they're about even. So you can see that what it's telling me is this is how much I'm going to need. Now I have all that I need between my pension benefit, my Social Security, and my retirement savings. And all I need to do is save $4,800 per year. Now that might sound like a lot, but what does that break down to in terms of pay periods? Let me divide that by 26 pay periods, and that's saving $185 per pay period. Okay. So all you would need to do is sign up for a 457B account and just have $185 per pay period taken out of your check, put into the 457B account. And by doing that, you get pointed in the trajectory of having 70 to 80% income replacement by the time that you get to retirement. Now, you're going to retire years from now, probably. So we're not going to get you pointed at it exactly right now, but we're going to get you pointed in that direction. Maybe you can't save $185 per month now. You can only save, or per pay period, you can only save 100. We'll get pointed sort of in the direction, then come back and save more a little bit later. And what I recommend is redoing these calculations periodically, and you'll notice that maybe it'll tell you need to save a little more, a little less, get point every time you do it. And so you can just adjust your savings over time. And by the time you get there, you'll have enough savings between your savings, your SARA pension, and Social Security to get to have 70 to 80% of your working income as your income in retirement. Okay. So I'm going to kind of skip over these so that I can let Gene start doing his thing, because we're kind of way over time now. This is kind of more information about where you might want to save your money. This is kind of some more information about the power of compound interest. This is about being cautious with where you're putting your money, because the greater possibility you have for return, usually that means a higher financial risk. You can meet with Gene or anyone from the 457B plan whenever you want, and he'll take you through this. So there was a question, can you meet with a personal planner? Yes, you can. If you sign up for the 457B plan, you just need to contribute $20 per month. Okay. And you can, and I'll just let Gene go through that. There's more info on that page about lower risk savings options, if you happen to have other ideas about where you might want to save your money. And then this is more information about getting financial planners. One word of caution: if you hire a financial planner, look very closely at the fees. They often want to charge you 1% of your earnings per year. That is a lot. Okay. So you can do way better than that. So just do some research on your own about how to get that fee shaved off. You can meet with Gene Hilliard for free if you sign up for a 457B plan. And like I said, there's that expanded article at acera.org/planning, which I showed you. And then you can sign up for Acera News if you go to acera.org/subscribe. This is how you keep track of important stuff that's going on with Acera. We don't hardly send out anything, only when something major happens that we need to tell you about. Okay, so without further ado, I'm going to turn it over to Gene Hilliard to talk to you about the 457B plan. Are you there, Gene?
I am here. Let me go ahead and share my screen.
Great. Let me stop my share.
Okay. All right, let's see. All right, how does that look?
That looks good. And we are, so, like I said, we're a little over time.
Okay.
You can feel free to go. I mean, you can do your full thing, and if people need to leave, they can feel free to leave, and we'll just make sure to post the video as fast as we can out on the website.
Okay.
And
yeah,
people had a lot of excellent questions, so I just wanted to be able to get to them all. And we will, after the presentation, we'll both hang around for as long as you want and answer the rest of your questions. So feel free, take it away.
All right, perfect. Thank you so much, Mike. Again, this is Gene Hilliard. I'm Vice President, Financial Advisor of Emerge Financial Group. We're a financial services company in Oakland. We provide financial planning services. We offer, we do tax preparation. We also do accounting for small businesses. I was hired roughly 12 years ago by the county and by Prudential to provide retirement planning, investment advice, and education to county employees. So it's a pleasure and it's an honor to speak with you guys today. little bit about my background. I've been a licensed stockbroker for 19 years, helping my clients create wealth, maintain that wealth throughout the lifetime of themselves, their children, and their grandchildren. And I'm also a certified retirement counselor. And my goal as a certified retirement counselor is to help each and every one of you maintain your current lifestyle in retirement, right? What does that mean? My goal is to help you get to 100%, as Mike mentioned earlier, right? Typically, retirees really need 80. You only need 80, but I figure let's shoot for 100, right? And if we need to settle for 80 or 85, what have you, then so be it. But let's shoot for 100, right? But in order to maintain your current lifestyle in retirement, deferred comp is a great tool to make that happen. Okay. And I'm just going to kind of go through some slides. I'll kind of speed through it a little bit in the interest of saving time. Okay. So, why save with your deferred compensation plan, right? Typically, this is used strictly for retirement. But in my view, I look at deferred comp as a financial freedom tool, right? I look at it as a wealth building tool, right? I also look at it as an opportunity for you to gain power over your own destiny. What do I mean by that? Well, let's say, hey, you're now with the county. Say, folks in your department, or maybe the county in general, is getting on your nerves and you want to make a move, right? You have the money and the power, right, that you have saved to be able to do that. And you don't have to wait until retirement, right? That just gives you a little bit more power and control over your life, right? It's another tool to allow each and every one of you to live a better life if you use it correctly. Okay, so that's what deferred comp is all about. This is what I'm going to kind of cover over the next 20 minutes. You know, it's a great tool to bridge the gap from a Sarah and Social Security. Mike did an excellent job of telling you this is where you go for Social Security. This is where you go from a Sarah. If you're only going to receive 40% of your salary, deferred comp will help you get to 80, help you get to 100, right? We'll talk a little bit about automatic payment deductions. That's a great tool. You can invest on a pre-tax, after-tax basis. We'll talk a little bit about the investment options. Uh, we'll also talk about your distribution options once you leave county service. And we'll talk a little bit about catch up, and we'll talk a little bit about the loan feature. Here's a huge benefit of deferred comp that I like. Most folks who have an IRA, you pay your bills, there's money left over, you put some money into an IRA. If there's money left over, and we all know that oftentimes there isn't any money left over, right? That's money, you live in the Bay Area, rent's high, mortgages are high. It's rare that there's money left over. And if there is any money, you have an accounting mechanism in your head that says, I'm going to need it for this, or I'm going to need it for that, right? But here's how deferred comp works. Money, we make it simple. Money comes directly out of your paycheck. And oftentimes you won't miss it, right? So when you don't see it, you don't miss it, and you don't spend it. In the deferred compensation plan, you also have the ability to invest pre-tax or after-tax. And here's kind of an example of how that works. So on the left-hand side, for every dollar that you make working for the county, figure the government's going to take 25 cents, and only 75 cents is being invested. But if you invest pre-tax, the full dollar goes into the plan. Okay, so your money will grow much, much faster over time, right? It's like it's a built-in tax break. It's like writing off mortgage interest, or it's almost like having children. It's a tax write-off that you can take full advantage of, right? So let's say hypothetically you make 60,000 with the county, and you decide you want to put $5,000 into deferred comp. Uh, Instead of being taxed on the full 60, you'll be taxed on 55. So you'll save a ton of money in taxes. Okay. Um, and by the way, if you invest pre tax, you're eventually going to have to pay the taxes. but you're more than likely, in many cases, going to be in a lower tax bracket when you retire. All right. But say you're a person that feels as a country, we're running up debt as far as the eye can see. Seems like whether there's a Republican in office, Democrat in office, our taxes continue to skyrocket, right? And or we find that we're going to have to pay this tax bill. We're going to have to pay off this debt. So I believe taxes are going to go up on everyone, despite me making less money in retirement. And you want to get the taxes out of the way today. Well, you can invest in the Roth version of deferred comp. And the way that that works, you're putting money into the account. Say hypothetically, over your career, you put $100,000 into the account. It grew to $500,000. So that means $400,000 will be tax free to you, right? But obviously, here there's always a catch. That $400,000 that you've earned in interest, in savings, etc., will be tax free to you, provided that you're at least 59 and a half and the account's been open for at least 5 years. Okay, so check with your accountant, check with your attorney to determine which option makes the most sense, whether you go pre-tax or you go the Roth version. But it's available to you. Okay. We encourage folks to start investing in deferred comp as soon as you can so you don't have to play catch up, right? So here's a person that, say, hypothetically, I meet with, they're 25 years old working with the county, and I encourage them to invest $300 a month, given their goals. They still plan on retiring at age, or they plan on retiring at age 65. So we're looking at 40 years. This particular participant has $575,000. Okay, that's a pretty significant amount of money, right? But say this person that I meet with started with the county at 35, or maybe they waited 10 years before they contributed because they weren't making a whole lot of money. Maybe they were dealing with student loan debt, but now they're a little bit more back on their feet. So they're 35 years old. This person wants to retire at age 65 as well. So they have 30 years to invest. Assuming a 6% rate of return, you're looking at having $490,000 in retirement savings. Okay, so I think it's pretty clear that would change your retirement outcome. And here's an example of a person who's 45 years old. Because they waited so long to start saving, it's going to cost them. So I encourage them to invest $1,000 a month. Okay. Still plan on retiring at age 65. You're looking at $455,000. Still a pretty significant amount of money, right? So the whole point of this slide is obviously here we want you to start as soon as possible, because the sooner you start, the more money you'll be able to generate and create in retirement. Okay. But it also makes the point that if you do happen to start late, right, you're 45, 50, all is not lost. There's still an opportunity for you to put away a significant amount of money towards retirement. There are a number of different types of investments that you can get involved with respect to retirement. You have your IRAs, but as you can see here, the contribution limits are lower. If you're under 50, you can put away 6,000. If you're 50 and over, you can put away $7,000 a year. Your income determines whether or not you can actually get the deduction, right? You also have a 457B plan, what we're talking about now. If you're under 50, you can put away upwards of $20,500 a year. And if you're 50 and over, you can put away $27,000 a year. Income is irrelevant. So if you're making $1 million with the county, you're going to be able to deduct this money that you're putting in deferred comp. So we encourage you to take advantage of it. I know these maximums seem high, but just know that you don't have to do that much. Start with 20 bucks, 20 bucks a pay period. That's the minimum. Start with 50, 100. Find a number that you feel comfortable with and then just build on that over time. Okay. If by chance you're sitting on some money in the credit union, for example, not earning a whole heck of a lot of money because interest rates are so low, and maybe you want to put that money into deferred comp. Well, unfortunately, you won't be able to just write me a check and put it in deferred comp. That's not how it works because money must come from your paycheck. But we can somewhat trick the system, right? You can say, all right, Gene, I want you to take half my paycheck and put that in deferred comp. Obviously, here, when you get paid, you're short paying your bills. Well, what you can do is you can live off, you can pull money from your savings account, right? And continue to do that over time to take full advantage of the 50 and over catch up. Or there's also the ability where you can put away $41,000 a year, and that's the special catch up. But you have to qualify for that, right? And the way to qualify for that is number one, you have to be 3 years away from normal county retirement age. So for sheriff deputies, I believe it's 47 is the soonest you can participate. Regular county employees, 54 and a half is the earliest or soonest you can participate in the 3 year catch up. And I would encourage you, if you're interested, you're at that age right now, just contact Darnell Williams, DARNELL.Williams@acgov.org, okay, to take advantage of the 3 year catch up. And I see that there's a question. If I originally signed up for the Roth after tax, am I able to change the plan to pre-tax dollars? Well, if you've put money into the Roth, you cannot just move that Roth money into the pre-tax version. But what you can do is you can stop or lower how much you're contributing to the Roth and then just start adding to the pre-tax version of deferred comp. So I hope that answers your question. All right, now let's talk about how much do I need to save. That's a moving target. Uh, it's a personal decision, but there are a number of different questions that you need to answer when you're determining how much you want to save. But I typically tell people at least start with 10% of your salary. So just take 10% of your salary, or if you want to, find out exactly how much that is, just take 10% of your gross salary and then divide that by 26 pay periods, and that's how much will come out per pay period. Okay, so take 10% of your gross salary, divide by 12. Or you can make it simple when you sign up for deferred comp, say, I want to do 10% and go from there. But there are some questions that typically you want to ask yourself. And here are the questions here. At what age would you like to retire? Right? If you're retiring later in life in your late 60s, maybe you won't need as much, right? Or maybe if you want to retire sooner, 40, 45, then you're going to need a significant amount of money because you don't want to run out. How many dependents will you have? Where do you want to retire? What sort of lifestyle? So these are some questions you want to ask yourself, right? So you're taking a guess here. So it's retirement age. I talked a little bit about that just now. If you want to retire earlier, 45, 50, and you want to just stop working altogether, that's going to require a significant amount of savings. I'm sure some of you are thinking dependents. Gene, why are you talking about dependents? My kids are going to be grown, but who knows? Some of you may need to step up to the plate to take care of your grandchildren. It's entirely possible that your spouse becomes a dependent of yours. Maybe they're suffering through dementia, etc. So they may become a dependent. And that means that you may need to upgrade your house, put in a walk-in bathtub, etc. So that's going to cost. So that's something you want to think about as you're determining how much you want to put away towards retirement. Cost of living is also important. Where do you want to live? If you're going to stay in the Bay, it's going to be pretty expensive. So that's going to require you to put away a significant amount of money versus, hey, maybe you want to move down south. A lot of participants are doing that, where the cost of living is a lot lower. So you don't need as much. So ask yourself, all right, where do I want to live? And once you make that determination, then you can put together a plan to put away more or maybe even put away less towards retirement. What sort of lifestyle do you anticipate living? Right? Maybe you're living a modest to comfortable lifestyle now and you don't see that changing. And then that's fine. So maybe you don't need to put away that much more money towards retirement. But maybe you feel, hey, I've sacrificed my entire life. I put myself on the back burner. Now is my time. Maybe you're tired of driving that 20-year-old car and you want to buy something brand new. Maybe you want a new car every 3 years, right? Or maybe you don't want to have to even think about money or debate whether or not you should spend money or this or that, right? You want to live a luxurious lifestyle. Well, that's going to cost you. And if that's the case, come up with a plan to put away the appropriate amount of money towards retirement. There's a lot of talk these days about income inequality, and it's legitimate. Seems like the rich are getting richer and richer and richer, and the rest of us are either like running in quicksand or we're just not getting anywhere. And I want to encourage folks to this is deferred comp is an opportunity for you to create wealth, right? So let's say hypothetically, another 2008 type of scenario pops up where you live in a house you're renting, maybe it's worth a half a million, but because of a crisis, et cetera, that same house is now worth 250. Wouldn't it really be nice to be able to take advantage of that opportunity? Right? And that's what the rich continue to do. They have money sitting on the sidelines and they're taking advantage of opportunities to present themselves, right? A lot of participants back in 2008 were borrowing against their deferred comp and buying real estate. And you can do that. Now, most people will use deferred comp for retirement, but like I said earlier, some folks use it as a wealth building tool as long as you're using the money responsibly. Now, I'm not in any way suggesting that there's going to be another 2008, but recessions, they do come and go. They're normal. They happen within 4 to 10 years. So the question I ask all of you is, will you be ready if another opportunity presents itself? Okay. So we've talked about how much you should save, the importance of deferred comp. Now we're going to talk a little bit about the investment options. There are 12 investments in deferred comp. Bear with me here. There are 12 investments in deferred comp. You have, if you're not a risk taker, you don't want to take on any risk, well, there's the Alameda County Stable Value Fund. Pays roughly 1.5% guaranteed, no risk. If you're a person that wants to invest in a socially responsible way, you want to invest in companies that care about diversity, that care about climate change, well, there's an investment in deferred comp for you. Maybe you're a person, you've done your homework and you believe that index funds are the best investment options because they're very inexpensive. The internal cost of those mutual funds are very low. There are index funds in deferred comp. But if you're a traditional investor, you want to create a asset allocation that's appropriate for you and your family, well, we have small cap companies you can invest in, medium sized companies, large companies. You can invest internationally. There are bond funds. So you can create your own portfolio on your own. Okay. But before you do all that, these are some questions you want to ask yourself when you're signing up and determining how you want to handle this in terms of investment. Can you pick your own investments? Can you manage your investments now and through retirement? Right? Do you have the expertise? Do you have the time to research the right funds at the right time? So these are questions you want to ask yourself, right? If you can answer those questions and say, I can handle it, I have the expertise, then you can create your own portfolio. And we encourage you, log on to prudential.com/retire wow, click on investment options and do your homework. Pay special attention to the performance going back long term. Pay special attention to the internal expenses, very important. The manager who's managing the money, and then create your portfolio. But many of you are experts at what you do for the county. You're not an expert in the markets. You don't have time or the energy to want to have to pay attention to that. Well, there's a asset allocation tool called GoalMaker. It doesn't cost you any money to take advantage of that tool. Okay. Here's how it works. You tell us what your investor style is. Are you a conservative investor? Are you a moderate investor? Are you an aggressive investor? Right? If you're unsure of what your investor style is, we have a risk tolerance questionnaire you can take online. We'll ask you some questions about how you feel about money, and we'll create that will give you the what your investor profile is. The next step is you want to tell us what your when you anticipate retiring, or when do you anticipate starting to withdraw the money? Is it 65? Is it 60? Is it 55? Once you give us that information, then we will create a portfolio for you. And within GoalMaker, it offers automatic rebalancing. What is that? Well, let's say hypothetically, the system decided that you're an 80-20 investor. 80% of your money should be invested in stocks, 20% should be invested in bonds or cash. And over time, let's say the market performed really well and your 80-20 portfolio turned into a 90-10. And what rebalancing does, it will get you back to your original asset allocation that we felt was appropriate in terms of your risk. So we'll sell certain areas, buy certain areas to make sure your portfolio is in balance. Another tool that I like about GoalMaker is it offers age adjustment, and it happens automatically, right? So as you get closer and closer to retirement, the account gets more and more conservative. So that's a great tool to take advantage of using GoalMaker. Okay. So let's say you've worked at a variety or at different counties, different jobs. You have the ability to consolidate. So you can roll money in from the outside, right? But do your homework. What you want to do is you want to compare costs. How much did it cost me to keep a plan at, say, San Francisco? And how much does it cost here with Alameda County? So compare. Very, very important. Some of you, I'm sure, probably worked at nonprofit organizations. You have 403Bs. Those plans tend to be extremely expensive because they're small. Really, the size of the plan makes a huge difference in terms of the cost structure. There's over $1 billion here with Alameda County. So the economies of scale is huge. So your cost structure is very, very low. So if you're interested or you want some more, you need to have some questions answered regarding whether or not it makes sense to roll over money from a previous plan, please do not hesitate. Just let me know. Okay. Once you leave county service, whether you retire or you just leave to go do something else, there are we're really, really flexible in terms of your distribution options, right? So some of you may elect, you can leave it with the county, leave it in Prudential, let it continue to grow. You still have access to my services. Okay. Or, some of you, for example, your bills are $5,000 a month. You're going to get between Social Security and Acera. You're at 4,500. That means you're short $500. Gene, send me $500 a month until the account's exhausted. So we can do something like that. So it's completely flexible. We can send you money monthly, quarterly, once a year, right? But just keep in mind, if you invest pre-tax, then just know that Prudential is going to automatically withhold some taxes. So you're looking at 20% federal, 3% state if you're still in California. So just keep that in mind. But it's completely flexible. Okay. You can elect to roll it over to a new plan if you choose. You can roll it to an IRA once you leave county service. Check with me. Let's make sure that you're making the right decision with this money once you leave county service. Okay, so what are the next steps? Just log on to prudential.com/retire-wow and click on enroll in the plan. Don't click on register, click on enroll in the plan. And once you've started the process of signing up, I want you to continue it, do the DocuSign, don't stop. Because if you stop entering information into the system, you're going to get busy and it'll be a year before you sign up, right? We want to get this thing set up as soon as possible so you don't leave any money on the table. When you're going through this process, there are a couple of areas where people get a little tripped up. Number one, once you leave or once you sign up for deferred comp, we're going to want to know who's going to inherit this money if something were to unexpectedly happen to you. So you're going to need to enter your beneficiary information, right? And we ask for socials. Most people don't have their kids' socials handy, so they stop. No, we don't actually need the socials on the front end. Just give us a name, give us a birth date, relationship, address, leave the socials blank, and keep it moving. Okay. Another area where folks get a little tripped up is on the investment piece. Hey, I'm not an expert. Do I do this myself? Use Goalmaker, call Gene. My recommendation is to just sign up for Goalmaker on the front end. Just put in that you're a moderate investor and that you're going to retire at 65. Even if that's not completely accurate, just leave the defaulted age at 65 and keep it moving, right? You can always double back with me later to say, Gene, I signed up for Goalmaker, moderate, age 65. Does this make sense? Should I do anything different, right? And then go through that DocuSign process and get the ball rolling. It takes roughly 2 pay periods for your first contributions to take place. Or if you want to increase your contribution, it typically takes 2 pay periods for that to happen. Okay. If you need some assistance, you're not alone in this whole retirement planning journey. You have myself in the middle. You have Mark Tomei with Wells Fargo Advisors on the left. Jason Brummett with retirement. He's a retirement counselor with Prudential. You can schedule an appointment with any one of us. Just call this number 855-969-4572. Hit option 3 to schedule an appointment. You can log on to prudential.com/retire wow to schedule an appointment. We're not doing any in-person appointments right now. We're doing mostly virtual or phone. But if you want to bypass the 800 number, you can call my office directly at 510-562-6355. You'll speak with either Linda or Penny. Let them know that you're an Alameda County employee. That means that's code word for VIP. And it means you're going to get the first available appointment out there. Okay. So call my number. You can also email me at G_Hilliard. So that's G_Hilliard, HILLIARD, at emergefinancial.com. Okay. So there are a couple of questions. Let's see. A couple of questions here. What you want me to repeat my number? It's 510-562-6355. That's 510-562-6355. And then there's another question. What is the interest rate on the Alameda County Stable Value Fund? It is 1.54%. Now, I know it doesn't sound like a whole heck of a lot, but I challenge you, go to the credit union, go to B of A, go to Wells Fargo, find out what their regular savings accounts are paying. It's pennies compared. So it's 1.54%, and that changes quarterly. So it could go up. Interest rates are due to go up probably this year. That's what I'm anticipating. So the interest rate on that savings account or on the Alameda County Stable Value Fund is going to go up. Okay.
All right. Thank you so much, Gene. We
Oh, it's
really
my
appreciate your
pleasure.
presentation. Yeah.
Mhm.
And yeah, thank you all for joining us. And we really wish you an amazing career and a wonderful retirement. And thanks for spending this time with us. And we wish you a beautiful rest of your day and a beautiful life. Thanks.